If you ever needed to be bribed to watch a financial film,
Stop it, please, I beg you!
I've got the scene for you.
Here's Margot Robbie in a bubble bath to explain.
The Biggest Short was released in 2015 and is based on the book by Michael Lewis. It covers the period leading up to what became known as the Great Financial Crisis, which started off primarily as a US housing crash.
This is going to be one of the watershed days in financial markets history.
The movie follows three separate but related narratives of unconnected investment funds that made massive profits by benefiting off the 2007 and 8 housing crash in the US mortgage and banking sectors. A short is the process of selling something in the hope that you can buy it back at a lower price later. Essentially, these funds made huge bets against the US housing market in the form of shorting mortgage-backed securities. Now look, there's a lot of technical jargon in this movie, but the director uses a lot of straight-to-camera explanations from various stars such as Margot Robbie and Selena Gomez in order to explain some of the technicalities. We'll summarise some of these ourselves, as well as go through the three main arcs of the story before giving our deeper insights into the entire scenario in the film itself. So the story is really started by Michael Burry of Scion Capital.
Soon, I would see financial Armageddon with housing as its trigger point.
A one-time medical doctor, he realised very early in the process that the US housing market was massively overvalued, with demand turbo boosted by the growth in subprime mortgages. Mortgage-backed securities have been around for decades and have traditionally been good, steady and low-risk business for a bank. Most people are pretty keen to keep the roof over their heads and put paying the mortgage at the top of the list of spending priorities. Wall Street, being Wall Street, managed to make them toxic. They did this by blending much riskier subprime mortgages in with those AAA mortgages, and persuading the powerful ratings agencies, namely Moody's and Standard & Poor's, that the diluted concoction would continue to achieve a AAA rating. The basic idea was, even if some of these risky mortgages didn't pay off, the overall spread of mortgages would be fine. And the demand from investors for these super safe AAA bonds resulted in mortgage originators flooding the market with masses of subprime or ninja mortgages. Ninja stands for no income, no job, no assets. Not exactly someone you want to be giving a massive loan to. Now, as the film illustrates, these AAA bonds became more and more filled with actually really bad mortgages, and it got to a tipping point where so many of these mortgages were failing, the housing market was itself failing, and these bonds, these mortgage-backed securities, were becoming worthless.
And then that happens.
What is that?
That's America's housing market.
The inevitable crash would always have had dire consequences for the housing market and the banks, but the ultimate effect was hugely magnified by the unimaginable leverage. Now, leverage just means borrowing someone else's money and using that as well as your own money to buy something. The more leveraged you are, the more money you've borrowed, and a smaller percentage of the money you've put in is your own original investment. Now, this time round, the leverage here was introduced by a whole new category of banking innovations. And just random FYI, if a banker ever tells you he's got a product to sell you, run the other way very fast. These innovations included credit default swaps, CDSs, collateralized debt obligations, CDOs, and CDOs squared and synthetic CDOs. In the movie, they explain some of this with a cutaway to Selena Gomez.
Okay, so here's how a synthetic CDO works.
Essentially, all you really need to know is that more and more and more money was finding a way to be bet on the success of these mortgage-backed securities. The too long didn't read is, if these mortgage-backed securities fail, not only are they failing, but all these other things are also failing. And while there's only a few million here, there's hundreds of millions here. Now, going back to Michael Burry, he was so far ahead of the curve in realizing the problems at the heart of the American housing market that he had to ask individual investment banks to design products specifically for him in order to short the market.
Yes, it's a foolish investment, but everyone's wrong.
Now, initially, even though Burry was very confident that his long-term projection was correct, these products he had made were massively eating into his fund's capital. And so much so that his investors were very, very scared and wanted to take their money out, becoming quite threatening in the process of telling him they want their money back.
Give me my fucking money back, you motherfucker.
He had to freeze the assets, refusing to let anybody take their money out of his accounts.
In order to protect investors from this fraudulent market, I've decided to restrict investors' withdrawals until further notice.
And in the end, he was proved very, very successful, and all these reluctant investors made boatloads of money while the rest of the market was falling around them. Now, this isn't featured in the movie, but Burry was once again very, very correct. Years later, he bet on an inflation cycle that also happened. So long story short, this guy is pretty good at what he does. And it was his idea that was actually accidentally discovered by a few other people in the film. Step in, storyline 2.
Paul. Where'd you go, Paul?
So Front Point Partners actually heard about this whole idea of shorting the mortgage market because of an accidental phone call. Mark Baum, who runs this fund, is already a cynic on Wall Street, and he is kind of happy to be betting against the people he hates.
Short everything that guy has touched. I want $500 million more swaps.
They met with Jared Vennett, who also believed that the MBS market was a massive Jenga tower waiting to fall down. The Front Point analysts make a field trip to Florida to see firsthand the extent of the problem. Hundreds of empty new builds which have been repossessed. The local stripper who owns 6 houses. Realizing that the bubble is very real, the fund decides to short the market.
Hey, there's a bubble.
How do you know?
Trust me, call Vennett. Like 50 million in swaps on the MBS. What do we got? Garibaldi 4 triple B.
Mark, you sure?
Yeah.
Scenario 3 looks at the Brownfield Fund, which is actually just 2 kids in their garage. They stumble upon the promotional material in a lobby at a bank and discover this whole problem that way.
Okay, so this part isn't totally accurate. You know, we didn't find Jared Bennett's housing bubble pitch in the lobby of a bank that rejected us. The truth is, a friend had told Charlie about it, and I read about it in Grant's Interest Rate Observer.
Based on this material, they do their own research and discover that, yeah, there is a massive bubble, and they decide also to short the housing market. They rope in an old family friend and ex-security trader Ben Rickert, and they risk the very survival of their fund by taking an aggressive position against the mortgage-backed security market. This storyline deals a little bit with the philosophical points raised by this friend that banking is reducing the people here to numbers, and that they're betting against people, betting for certain things, without maybe fully realizing the extent of what they're doing.
You know what I hate about fucking banking? It reduces people to numbers. Here's a number, every 1% unemployment goes up, 40,000 people die. Did you know that?
The storyline also covers the disgraceful shortcomings of the media, who completely fail to join the dots on what's happening, and even when it's presented straight to them, don't want to print anything about it because they don't want to rock the boat.
I'm not gonna burn my reputation on your wild hunch.
I have to say, I think Richard Nixon would have loved the press to be more like this during the Watergate scandal. It also points towards the regulators who didn't have any serious regulatory measures against these mortgage-backed securities and the CDOs built on top of them. And going back to Baum and Friends, they investigate the ratings agencies and find them to also be asleep at the wheel because they're using outdated formulas in order to greenlight these terrible bonds. The tension in the film is cranked up as all 3 funds are nervously awaiting for their bonds to come good, but they begin to panic a little bit when the mortgage market holds up longer than any rational analysis would suggest. This happens partly because the whole thing's pretty goddamn crooked. Even when the values of the securities are going down, somehow the values of their bonds are going up, and so their shorts are looking bad, even when they shouldn't.
I just had to wire Bayer and Deutsche $70,000. It's like 2 + 2 = fish.
It's rigged. You bought into a rigged game? Lose.
Again, very crooked. But of course, the crash eventually happens, and all our heroes go running off to the sunset with their big piles of money. Thing is, for the global economy, things weren't so rosy. One thing to understand clearly here is they were betting against the status quo, the way the world was running, especially the financial world. When their bet came in, it's because the world, in financial sense, was going to hell. Specifically, of course, the US housing market, but this had a knock-on effect to essentially every market around the world. Now, the US housing market was decimated. Some banks simply collapsed, Bear Stearns and Lehman Brothers being the 2 most notable cases. The chaos caused by the Lehman Brothers implosion led to tax-funded government bailouts for scores of other banks and financial institutions. A global recession followed.
In a nutshell, 2009 looks like what to you?
Miserable.
2010.
Miserable, even worse.
Converse to perhaps the conventional wisdom, this was actually a good time to be an investor, provided you had some capital behind you. If you had all your money in the market, not such a good time to be an investor. As we'll talk about plenty on this channel, it's very, very good for prices to fall when you're in a position to buy. Essentially, this was the Black Friday sale of the stock market, where wonderful companies were being dragged down by the current, and their prices in terms of buying as an investment for the long term were very, very attractive. At the same time, this was a great time to buy a house, because the housing market was collapsing. Now, admittedly, since then, the housing market has bubbled back up again, and as many online jokes would tell you, people are very sad that at the age of 8 in 2008, they weren't buying a house but were instead going to school. So a subtle observation for you. When Mark Baum talks to his senior at the bank, she tells him that the bank is in a lot more trouble than he'd anticipated. And he then goes back to his fund and tells him to short the bank.
Short the bank stocks. Wait.
Now this is insider trading, which is illegal. Now the thing about insider trading is it's a little bit of a blurred grey line sometimes. This is a case that very much would, at least in our opinion, constitute insider trading. But to be clear, his questionable moral action here is absolutely nothing compared to what's going on around him, compared to the corruption, compared to the lying, compared to the things that should be landing people in jail. Another nice moment in the film was when the two boys get into a trading office and they see this place they've idolized. The start of the film is them essentially trying to get a foot in the door on Wall Street and being told they're too small. Now they get into this bank. I think it's supposed to be leaving in the film, don't quote me, but they get into this bank, they see these offices that they once idolized, and there's a nice little moment where they're clearly realizing they've been worshipping false idols. This place is a shell, hollow, nothing like what they thought it was going to be.
This isn't how I pictured it.
What'd you think we'd find?
I don't know. Grown-ups.
I remember remarking to the people I was watching the film with, it's a little bit like finding the Holy Grail and finding it's made of plastic. Now, after all of this, mortgages are still a huge market. So could all of this repeat and happen again? You might be surprised to know that financial innovations like CDOs weren't explicitly outlawed or completely disappeared. They're kind of back under different names. The film does tell us this as well. They're now reborn as bespoke tranche opportunities. At the same time, the Trump administration has pledged deregulation, which is a key part of his platform in both electoral campaigns. So, are we just gonna head straight back for the same thing again? Well, banks aren't as exposed to housing as they were in 2008, so a modern crash wouldn't bring them down in the same way. Plus, as the saying goes, generals are always fighting the last war. So the next financial crisis is not as likely to be in the mortgage market. But some of the features of the mortgage-backed crisis are common to financial calamities. You could see the same in, say, the modern crypto market. For example, what they call MicroStrategy could be compared to something like CDOs. If you want to go look that up in your own time, go for it. We will cover it at some point because it's frankly a good thing to laugh at. Now, the people who made so much money out of this whole situation were crooks. And they got away with it. Now we're in another housing bubble, people are making huge amounts of money again, excrement still floats, and the game isn't fair. Sometimes the game of money can feel rigged at a macro level, with governments desperate to keep that housing market afloat because governments are very interested in short-term results. No one ever got re-elected during a housing crash, so governments feel tied into doing everything they can to keep housing markets going. And that means that people who bet on the housing market are often unfairly rewarded. This is just another side of the unacceptable face of capitalism. Conversely, consider for a second the poor suckers on Main Street. They, as well as the rest of us, have paid taxes in order to bail out the Wall Street gamblers. And what about the poor families that lost their homes? What about the millions of ordinary people who lost their jobs in the reaction which inevitably followed? To be fair, the movie did touch on these tragic consequences right at the end, but they more focused on a different important question. How many of these Wall Street crooks responsible for one of the biggest heists in global history got jail time? And those of you who watch the film know that the answer is 1. Step forward, sacrificial lamb Kareem Sarah Gelden. Such a big name, I don't even know off the top of my head. From Credit Suisse. Sentenced to 30 grueling months for the crime of mispricing bonds. This is the only guy. It's so laughable. So most of this movie tries to deal with the exploits of a number of market participants trying to exploit irrationality and corruption in the system for their own enrichment. Fair enough. Still, we find rooting for the selfishly motivated hedge fund manager just a little hard to swallow. Better surely to spend more time on the real and obviously innocent victims of all this graft, maybe? There's a better movie to be made on that subject. However, it does still get credit for showing some of the people who were affected, a far sight better than films like The Wolf of Wall Street manage. Nor does it in any way glorify the crooks, which is once again quite a lot better than The Wolf of Wall Street manages. It does show some fraction of the real world fallout, still not enough in our opinion, but at least some of it. The Big Short gives us a wide-angle view of the overall market crisis. However, for a more in-depth view of the actions of one bank itself, you could watch Margin Call, which we've also reviewed on this channel. If you enjoyed this review, please do all the YouTube things, it helps us out tremendously. And if you'd like to learn more about the markets, this is the place to be. See you all in the next one.